Good afternoon and welcome to today's Investor Spotlight event featuring 5 companies ready to present an overview of their investment case and why they believe their company is an attractive opportunity for investors. So let's get started. First up, we have Alan Lockhart from New River. Alan, great to have you here. Let's jump straight in. What's the latest from New River and why should investors take notice?
Well, thank you and good afternoon, everyone. I'm absolutely delighted to be here to be able to talk about New River. I'm going to start with a couple of introductory slides. New River is a REIT. We specialize in UK retail real estate. We have a team with vast experience and expertise. We're predominantly based in London with small satellite offices in Manchester and also in Scotland. And we're a business that has been going since 2009. With retail real estate becoming more and more operational, we've invested in our business in terms of the quality of our people, our systems, and our access to data. And that is delivering very strong operational results, as we will go through later. The business is completely underpinned by a very strong balance sheet. We have about £170 million of cash and liquidity. We're an investment grade borrower. And our business is in great shape looking forward. And last year, in 2024, it was quite a transformational year for us. We've engaged in 2 corporate transactions, one small transaction acquiring an asset management business called Ilandi, and then our first public M&A transaction of the acquisition of Capital Regional. And the combination of our strong operational performance plus the acquisition, particularly the Capital Regional acquisition, means that the business is set to deliver material earnings growth over the next 12 to 15 months. Our business is really in 2 parts. We have our own balance sheet assets, which total close to £900 million. Predominantly our portfolio is invested in shopping centres and retail parks. The type of shopping centres we own are located in the heart of where communities are. Over 70% of our consumers travel less than 5 miles to our assets. We have high frequency of visits. A lot of our assets are food anchored. And so it's where the consumers are spending their weekly household budget. And then our retail parks is really all about omni-channel retailing. And we will talk about that later. But both our core shopping centres and our retail parks are performing very well. The second part of our business is where we're providing high quality asset management services to investors that want to be invested in UK retail real estate. And the best way and the wisest way to do that is through a platform like New River, because we provide a best-in-class asset management service. So when we add on the assets that we manage on behalf of others together with our own balance sheet assets, you can see on this slide the scale of our business. In total, we're owning and managing nearly £2.5 billion of assets. We're collecting £225 million of rent per annum from around 3,500 tenants. And we're active in almost every region in the UK. And of course, this gives us incredible insights as to what's happening with consumers and retailers. And we're able to use those insights to deliver better performance going forward. But why retail real estate? Well, despite the fact that retail has been highly disrupted over the last sort of 10 years with the growth of online retailing, we would arguably say today that our marketplace is in the best position it's been for 5 years. And there are a number of reasons for that. First of all, it starts with the consumer. There's no doubt the consumer has been more resilient than perhaps financial markets had anticipated. We know that wage growth is running higher than inflation, which is supportive of rising living standards. Unemployment levels from an historical perspective are low. There's elevated job vacancies. House prices are broadly stable and consumers are still sitting on elevated savings. And that is feeding through to consumer spending. And you can see on this slide here, which is data provided by Lloyds Bank, that consumers spent in retail and supermarket, the year-on-year growth was 1.9%. But to the right of that, you can see what the year-on-year spend growth in New River's assets, it's around 6.2%. So we're materially outperforming the wider market, and that's reflective of our portfolio positioning. But in terms of the occupiers, a lot of the corporate restructuring has already taken place, and that has meant the weaker retailers have left the marketplace, and with that, the excess competition, and that's been really beneficial for the market. Most retailers over the last 7 to 8 years have applied a laser focus on margin and margin growth, in other words, profitability. And that they've been able to do that by really driving operational efficiencies through their business, but also including portfolio positioning. And Marks and Spencer's is a great example of that, because they're now back in the FTSE 100, not only delivering great results, they are delivering brilliant Marks and Spencer's results. And then finally, it's just the rise of the omni-channel retailers. They're getting stronger and stronger. They're taking market share away from pure play online retailers. And they've been doing that because they've invested in connecting up their physical network with their online channel, and they invested in their digital capability as to how they transact and communicate with customers. So we're seeing occupational demand rising, and the underlying occupational markets from a financial perspective in a much stronger position. And this has now been picked up by the capital markets. There's no doubt that retail is starting to become on the agenda for investors. It's been led by retail parks, where the liquidity has been strongly flowing into the market, and that's been supportive around valuations. But we're now starting to see the liquidity building up for UK shopping centres. So what makes NewRiver unique? Well, really it's down to what we deliver operationally. You can see on this slide that we have consistently benefited from very high occupancy. Our retention rate, again, is also well into the 90s. And what that is, the retention rate is saying is that when our tenants come to lease expiry, or when they have a break, the vast majority of them are staying in our assets because they are trading profitably. And that's why our occupancy has also been very, very strong. And this is feeding into really strong leasing performance. We've now had something like 7 quarters where our new leasing deals have exceeded the value as ERVs. And we've now had 5 quarters where our leasing deals in terms of rent are higher than the previous passing rent. And of course, because we're experts in retail with vast experience, we are being able to significantly outperform the wider market, as referenced on this slide, versus the MSCI. We consistently, over the long term, outperform the MSCI, not just in shopping centres, but also in retail parks. So what is the growth opportunity for NewRiver, or what's NewRiver going to deliver our shareholders? Well, you can see on this slide, which really demonstrates the benefits of the major transaction that we completed at the end of last year, the acquisition of Capital Regional PLC. So this is showing very, very strong earnings growth over the next sort of 12 to 18 months. You can see we reported a half-year earnings per share of 3.7 pence for our half year through to the end of September. If we were to annualize that, that takes you to 7.4 as a starting position. We did an equity raise to partly fund that transaction with Capital Regional, a highly successful equity raise where we were 2 times oversubscribed. So taking account of the additional shares that have been issued, that takes you from 7.4, take off 2.6. Then you can start to see the contribution coming in from Capital Regional, 3.3 pence, and then a further 1.3 pence of the synergies that we will be unlocking within 12 months. That totals about 6.2 million. And then when we take account of some modest disposals to reduce our LTV post-transaction, and also refinancing one of the Capital Regional loans in January 2027, we end up with an enlarged pro forma of 8.7p from a starting position of 7.4. And that's about 18% earnings accretion over the next 12 to 18 months. And that will be, in our view, one of the top performing earnings growth story in the in the REIT market. So why invest in NewRiver? Well, the shares are trading at a very material discount, 30%. In the meantime, we are delivering a very attractive dividend yield. underpinned by very robust rental cash flows. And as the benefits flow through from the Capital Regional acquisition, we expect that the value of our business will increase, driven by the increase in the share price. And so we expect that our shares will deliver material capital return sitting alongside a very, very attractive income return. So when you look at it from a total return, we think the proposition is very, very compelling. But it's not just the acquisition of Capital Regional. We have a number of other growth opportunities within our business, growing our asset management business where we provide asset management services to other investors. We expect that to double over the next sort of 18 to 24 months. We think our portfolio is set now to deliver consistent rental growth. That's great for the P&L, and that should feed through to valuation growth and allow us to access some of our undrawn liquidity. And of course, capital recycling, which is an important discipline that we've always adopted, is a way for us to be able to sell assets and recycle our capital into new opportunities that are going to deliver higher earnings. And we'll be achieving all of this whilst maintaining very, very strong financial discipline. Well, thank you for listening. I'm happy to take some questions.
That's great, Alan. Thank you very much indeed. I guess one question, to wrap up with, Alan, I mean, you're trading at a 30% discount. What do you think that tells an investor?
Well, there are many factors that go into the rating of a company. I think, a couple of key factors for us at the moment is, first of all, the state of the UK stock market. There's no doubt that we've seen in the UK stock market consistent equity outflows, particularly to the US. And of course, we're a REIT, so there's been quite a bit of volatility in the 10-year gilt and the 5-year swap rate. And that has been impacting the prices or the share prices of various REITs. But there are signs now, particularly with the new administration in the US and the disruption that is coming through, that actually the UK could potentially be a beneficiary in terms of that reversal of outflows and inflows coming back in. But ultimately, we think, and it's what we can control is the most important thing, by delivering the benefits from the Capital Regional transaction, that material earnings growth, we think that will have to result in an increase in the value of our business, with the share price driving that. But our shareholders will be paid to wait, because in the meantime, they are going to receive a very attractive dividend yield that is fully covered.
Alan, thanks very much for your time today. Before we move on, if you'd like to be automatically invited to future updates from New River, then please respond to the poll now, and we'll ensure that you stay connected. Okay, now let's move on to our next company. Joining us now is Bradley Biggins, Portfolio Manager from Schroeder Real Estate Investment Trust. Bradley, thanks for joining us today. Let's get straight into it. Can you tell us a little bit more about the company and what's driving the business forward right now?
Absolutely. Thanks, Mark. Delighted to do so. And it's great to be talking to investors through the Investor Me Company platform. I'm here to talk about Schroeder Real Estate Investment Trust Limited, also known as SREIT. And I'm talking to you in the context of a really interesting point for the UK real estate market. And in fact, we're forecasting returns of 8 to 10% per annum for each of the next 4 years. That's made up of a 5% per annum income return, as well as some capital growth, which is driven by rental growth, as well as some modest yield compression. Now, bear in mind, this is an average of all UK real estate, and historically, SREIT has strongly outperformed its benchmark, and we'll touch on that in a moment. Moving on to the next slide, we show the context behind why we're feeling so bullish on UK real estate today. Well, since June 2022, we saw a 25% decline in average real estate valuations, and that's shown by the dotted blue line. More recently, we're seeing recovery in those valuations, particularly in retail warehouse and industrial sectors, which is where the majority of the SREIT portfolio is allocated. Now, despite these falls in valuation, rents have grown strongly over the same period. And on the chart in the top right-hand corner, we're showing the rental growth post downturns for the industrial sector. And what you can see is that since June 22, rents in the industrial sector has grown on average by 18%. This is clearly in contrast to the previous two downturns that we've shown on the slide. And we also expect this rental growth to continue. Now, why is that? Well, we've also seen construction costs have risen materially, particularly in the last 4 years. And what this means is the pipeline of new space coming through is very thin. In addition to that thin pipeline, there's a shortage of high quality ESG compliant space in the market. And that's shown by the red bars in the chart in the bottom right hand corner. So following a 25% valuation decline, we expect an attractive income return. And with rental growth and some modest yield compression, perhaps helped by further interest rate cuts, we think it's a really interesting point in time for the UK real estate market. Moving on. Now, we've got a really clear strategy as to how we're going to generate total return in what we think to be an attractive period for UK real estate. We believe that by making meaningful improvements to the sustainability performance of our assets, we can generate really high rental growth and also valuation increases. We're able to do that because of the green premium, and we think that we have the expertise required to profitably generate that green premium. Now, what's interesting is since we launched this strategy, which became effective on the 1st of April 24, we've got an increasing number of examples of where we've been able to do this. And we're shown as a proof of concept Stanley Green Trading Estate on the right-hand side. On this estate, we developed 11 new EPC A+ BREEAM Excellent units. And what we've seen is that the rents we've been able to achieve on those new units are 39% higher than the rents on the older units on the existing estate. Now, we think that a key reason for that is the green premium. And not only are we getting higher rents on those units, but the independent valuer is applying a keener yield to the valuation of those units. So, for example, the green units are being allocated an equivalent yield of 5.2%, whereas the old brown units are being allocated a 6.25% equivalent yield. So together, that higher rent and keener yield have come together to generate a really attractive total return for this asset since we acquired it in December 2020. So we've achieved 17.3% per annum since that point in time, and that compares to the MSCI All Industrial benchmark at 8.3% per annum. So this stands to be a really strong proof of concept of our sustainability improvement strategy. And we've only been able to do this because we've got a really deep real estate team focused on sustainability with technical experts, and that's a real differentiator compared to our peers. Moving on, here we show some really important portfolio metrics for SREIT. And what this demonstrates is another element of our approach, which is the research-led approach we have. We've got a dedicated team of real estate researchers, and they help us with portfolio construction from a top-down perspective. That combines with a bottom-up perspective that we get from our extensive team of sector specialists that we have on the ground in the UK, based in both London and Manchester. So we get really good market intelligence. Now, some key points to take away from this slide are our overweight allocations to industrial and retail warehouse. And in fact, 63% of the portfolio value is allocated to those two sectors. And we see really attractive supply-demand dynamics in those two sectors at the moment. What you can also see, and this time in the table on the left-hand side, is the granular nature of our portfolio. We've got 38 assets and more than 300 tenants. That spreads risks, and we believe provides you with a more resilient portfolio. We also have a really attractive income profile. Our net initial yield is 5.6%, which is well ahead of the benchmark. And importantly, we've got a reversionary yield of 8.4%. What that means is the independent valuer believes that if we were to agree all leases today, all new leases across our portfolio, the rent would be £10 million higher than what it is. So it's currently 28.5 million. The independent valuer believes that could be 39.6 million. That's a really interesting opportunity because that £10 million in the context of our dividend is very material. Our annualized dividend today is around £17 million per annum. So if we can achieve some of that reversion, that could potentially mean we can continue to move that dividend on further than we already have. Now, moving on, this slide sets out how we're setting out to capture that reversion. And within our leases today, we already have fixed uplifts that are contractually, applicable. So we don't have to do anything to get these fixed uplifts. We've already achieved £800,000 of that since the year end, and there's another 4.7 million to come before the end of 2026. We also have a couple of units to let at Stanley Green, so that new development I mentioned earlier. There's £400,000 of rent up for grabs there, and around half of it is under offer at the moment. Then there are also areas where when we get rent reviews and lease renewals, we expect to achieve higher rents. And in fact, at a recent trading update, we showed that our rent reviews and lease renewals were 30 to 40% higher than the previous passing level of rent. And we're also working to reduce our vacant space to add to that top line rent. And moving on to the next slide, I mentioned investment performance. This is the underlying portfolio investment performance versus the MSCI benchmark. And as you can see in the bottom right-hand corner, we're outperforming over 1, 3 and 5 years. And in fact, over 3 years, we're outperforming by 4.9% per annum. And on to the next slide. A really important aspect I want you to understand about the company is a really strong balance sheet. And that's underpinned by the long-term loan we have from Canada Life. So that loan has an average maturity of more than 11 years and an average fixed interest cost of 2.5%. That's really attractive in the current higher interest rate environment and is a differentiator versus our peers. And that really underpins the strength of our balance sheet. It gives us great visibility on our interest costs looking forward, and that helps us to forecast what dividend we could potentially increase to in the future. And moving on. So, in summary, what's the opportunity of SREIT today? What is the investment case? Well, we've got an attractive portfolio focused on higher growth sectors with that really high reversion yield of 8.4%, which represents an additional £10 million of rent per annum. Now, not only is there the possibility of growing that dividend by capturing that reversion, but the current dividend is really attractive already. So we're offering a dividend yield of 7.2%, and that is fully covered by earnings. We've got a really robust balance sheet, and as I said, that enables us to have really great visibility on our future interest costs. Now, the shares are actually trading at an 18% discount to NAV today, and that offers a really attractive entry point to the company, particularly given the market recovery I spoke about earlier, the earnings growth potential from capturing that reversion, and also our evolving shareholder register. Because what we're seeing is a growing proportion of our shareholder register is being held by investors through platforms such as Hargreaves Lansdown, AJ Bell, and Interactive Investor. Finally, we have a really clear strategy to generate total return, and that's focused on sustainability improvements, where we believe we can do that profitably, generating attractive returns for our shareholders. With that, Mark, I'd welcome any questions, and I'll be delighted to answer.
That's great, Bradley. Thank you very much indeed. Very much indeed. Bradley, I guess one question really. What excites you most about the future opportunities do you see for Schroder Real Estate? And how do you see the company creating long-term value for investors?
Thanks, Mark. I think what excites me most about SREIT at the moment are the pipeline of opportunities we have to generate higher rents and to grow valuations. And that's in the context of a market that I think it looks attractive sort of in general and on average. So there's a couple of examples here we've got up on the screen. And on the left-hand side is one of our retail warehouse assets. This is Churchill Way West in Salisbury. And we got back 2 of the units recently. And the passing rent at those 2 units was £355,000 per annum at the end of December. And we negotiated a deal to bring Lidl into the majority of those 2 units, paying a rent of £440,000 per annum. Now, in fact, on a per square foot basis, that's an increase of 67%. Now, how were we able to achieve that? Well, we're working with Lidl to create a really sustainable unit. We're adding PV to the roof, EV chargers in the car park, fully electric HVAC systems and M&E systems within the unit. So all of that would increase the EPC of the units to an A, and it was previously much lower. Now, that's going to cost us £1.5 million to achieve. And the question is, is it worthwhile? Is it worthwhile spending £1.5 million for that increase in rent I spoke about? Well, in this case, we think it absolutely is. And this project is generating an income yield on cost of 12%, which is really attractive. And the yield on a retail warehouse like this would be far keener. It would be sort of 6%. Then on the right-hand side, there's another example, another live example. Here we refurbished 2 units on a multi-let industrial estate in Swindon. This is called Stirling Court. We moved the EPCs from a C and a D to a B. We've let one unit, one of the refurbished units already, at a rent that's 32% ahead of the previous passing level. And the second unit is under offer to a really strong company at a rent that's 41% ahead of the previous passing level. Now that's a couple of examples of our strategy in action. And we do have a pipeline of similar projects available to us. And that's what really excites me, because that's us achieving that high reversionary rent that could potentially mean we can continue to move that dividend on for our shareholders.
Bradley, thanks very much indeed for your time today. Before we move on, if you'd like to be automatically invited to future updates from Schroeder Real Estate Investment Trust, then please respond to the poll now. I will ensure that you stay connected. Okay, moving on to our next company. Joining us now is Bronwyn Curtis, Chair of 24 Income Fund, and Eleanor Rinaldi, Portfolio Manager from 24 Asset Management. Great to have you both here this afternoon. Let's dive straight into things. Can you tell us a little bit about 24 Income Fund and why investors should be paying close attention right now?
Well, thank you very much for that introduction. TFIF, as we call it, is an income fund. It's always delivered on its annual dividend target of 6 to 9% of the original issue price since it was launched in 2013. It's never had a default in any of its investments, and it invests in higher yielding, floating rate West European asset-backed securities and pays out all of its income as dividends every year. I just want you to make you aware of the disclosures and disclaimers and remind you that performance is not a reliable indicator of current or future performance. So let's have a quick look at TFIF's story since the IPO. Launched in 2013, 150 million. It's now close to 850 million in assets, and joined the FTSE 250 on the 16th of September 2022. It's achieved this growth by issuance when it was trading at a premium, the merger of UK Mortgage Limited, 150 million in 2022, and through the 3-year realization event, which is an opportunity for investors to sell as many shares as they like back to the company. In fact, it was meant to be a discount control mechanism, but they've actually raised money at 2 out of 3 of those realization events in 2016 and 2022. The next one is in October this year. Issuance has been reduced in recent times, but the growth trajectory through performance, you can see the performance on that big black line, continues to increase. So let's just have a look now at the total return and the yearly dividends. The red dotted line, it's a bit hard to see, but the red dotted line is our minimum payout, and that has been at 6p for most of the time. In the higher rate environment, we increased it to 7p in 2022 and then to 8p in 2023, and it's been there since then. So the green columns are the actual dividend paid out, and the black line is the NAV per share, the total return. So if you look at that little summary on the top there, you'll see that the total return since inception, nearly 154%. Total return since inception annualized, 8.1%. And so far in this fiscal year to the 28th of February 25, it's been 13.91%. Now you can see from this chart that we have achieved more than the 6p every year, and actually substantially more in some years. So far this year, we've paid out 2p per quarter for the first 3 quarters of the year. The last quarter is always a balancing quarter, so because we pay out all the income every year, and as we're running at performance has already been up to the 28th of February, 13.91%. We usually have a higher balancing dividend for the final quarter of the year, which is January to March, and we'll announce that sometime in April. So looking at the performance to date, the dividend coverage is healthy. The 8p target seems very achievable. And just looking at the fund information, just a summary there. Current mark-to-market yield, 11%, purchase yield, nearly 12%, average credit rating, BB-. And I think the annualized performance since launch, just over 8%. And we're doing very well this year. Just to say, on the discount, we've averaged -4% in the last year compared to most other funds in this sector. That's really, really good. And we are back to about par now. With that, I'm going to hand over to Eleanor, and she can tell you all the really interesting stuff about how they make that money.
Thank you, Bronwyn. As Bronwyn mentioned, the fund looks to achieve its target return by investing in a diversified portfolio of higher yielding European asset-backed securities. The opportunity set is pretty broad. In the public space, the ABS market is around 546 billion in size. It's a good size market. However, the high yield part of it is around 15% of total. And therefore, we're talking about 75 billion euros, which is smaller than for instance, the higher corporate credit market. And that's partly explain the premium offered by the asset class versus traditional fixed income. The market is evenly split between corporate risk and consumer risk, with consumer risk consisting in bonds backed by pools of mortgages, personal loans, car loans, and corporate risk being represented by collateral loan obligation, which are transaction backed by senior secured loans. Residential mortgage-backed security and collateral loan obligation cover roughly 80% of the total public ABS universe. And they were also the main source of supply last year, with record volumes since GFC. Banks are increasingly using ABS as a funding tool, which helps diversification, but also as a capital tool. And they're offering more and more mezzanine and junior bonds to investors to reduce their capital requirement. ABS and CLOs offer an attractive relative value versus traditional fixed income. Although performance has been strong in 2024, we've seen spread tightening and credit curve has flattened. Yields are still high versus traditional credit. Up until the end of February, most of credit indices were trading near historic tights, while European ABS and CLOs still discount some downside risk, partly because of that liquidity premium, so the smaller market, and partly because of the research intensive premium that as a manager require when we invest in the asset class. If we take, for instance, a BB CLOs, the current yield is around 9 to 10% in sterling, taking into account the recent volatility, and that assuming a further curve. So it's already taken into account the market expectation of future cuts in the next 3 to 4 years. If you compare that to a European high yield bond, so similar rating BB, we get 1.5 times additional spreads and yield for owning a CLOs, which is backed by a granular and diversified pool of loans. With the spread tightening that we've seen in the last couple of years, we do expect the driver of returns to come from carry in the medium term. And by looking at the current yield, that should represent an attractive source of income. The current positioning reflects where we see the best opportunities from a sourcing and a risk-adjusted point of view. We like senior secured assets at this stage of the cycle, such as mortgages and secure loans. The majority of the fund allocation is, in fact, in residential mortgage-backed security and collateral loan obligation. In terms of geography, we see best value in Western Europe and UK. The average rating of the funds is BB-, and there is a non-rated exposure, which consists of private opportunities, bilateral trades, bank capital relief trades that have provided a growing opportunity set for the fund and an additional source of diversification. The fund has a short credit spread duration, as you mentioned, 2 years, and very low gearing. This is done intentionally. Over the past year, we built a lot of flexibility in the fund without sacrificing yield. And we believe the fund is rightly positioned to take advantage of potential market dislocation and volatility that might come from geopolitical risk and trade tension. ABS generally benefits from cutting cycles. On one side, we have mortgage rates that have decreased from the highs, and that improve affordability, and fundamental performance continues to be very resilient on the consumer space. On the corporate side, in Europe, borrowers have enjoyed lower interest costs and improved cash flows, and the default outlook remain benign in the medium term. On the other side, the macro volatility seen in recent months and uncertainty around tariffs and Eurozone fiscal policy shift have led to an increased rate volatility and market adjusting their expectation for future rate cuts, with the Bank of England and European Central Bank forecasting only 50 basis point of cuts for this year. That ultimately means higher rates for longer, and we believe that such high rate environment continue to support an attractive return profile for the fund, which we expect will be dominated by yield. The fund has exceeded its dividend target in every year since inception, even when rates were close to zero. And with the book yield close to 12% currently, that represents an attractive opportunity for investor looking for stable, high income and exposure to a diversified portfolio of floating rate assets like ABS, which has demonstrated its credential through multiple economic cycles. The fund has outperformed the FTSE 100 55% of the time since inception, and is well placed to provide equity type of returns with lower volatility and higher distributions.
Elena, thank you very much for that. And thank you all for joining us today. I hope you found it useful and do enjoy the rest of your day.
Bronwyn, Eleanor, thank you very much indeed for your time today. Before we move on, if you'd like to be automatically invited to future updates from 24 Income Fund, then please respond to the poll now, and we'll ensure that you stay connected. Right, moving on to the next company. Joining us now is Ashley Paxton, Chair of 24 Select Monthly Income Fund, along with Owen Walsh, Portfolio Manager at 24 Asset Management. Thank you both for joining us this afternoon. Let's get straight into things. Can you tell us a little bit more about 24 Select Monthly Income Fund and why should investors take notice?
Well, thank you, Mark. Yes, as I've just been introduced, I'm Ashley Paxton. I'm delighted to be here this morning. I'm chair of the 24 Select Monthly Income Fund, and I've been on the board since 2021. I just wanted to start by saying, since we last presented on the company, it's continued to thrive, and it's continued to tap quite heavily into the market. It's tapped something in the order of 13,950,000 new shares since 30th of September, and it's actually grown in its market cap from 224 million through to 242 million. And that's not just from the taps, that's also been increase to NAV and its continual pull to par. So it's continued on its successful glide path. That's probably all I wanted to just introduce. I'll come back in a minute just to talk about our dividend policy. But with that, I'll just hand over, if I may, to Owen.
Thank you, Ashley. Yeah, so to give a brief overview of what the fund is trying to achieve, we have a target of delivering a minimum of 6p per annum to our investors. And the way we try to do this is to take advantage of the whole fixed income universe. We don't take any currency risk in the portfolio. Any non-sterling assets are hedged back to the base currency on the day we make the purchase. And we try to reduce or to hedge interest rate duration risk and also market risk if we think we need to. However, what we prefer to do is to try to position the company correctly or position in the best sectors that we think are suitable for the environment that we are in. We also have the ability to hold less liquid bonds. And this is one of the key considerations, I think, for the fund. When we're talking about less liquid, we're not talking about illiquid. We're talking about bonds that, for various reasons, may not be as liquid as you would like to have in a daily price fund. This could be because they're issued in smaller size, they're issued by less frequent issuers, they might not be rated, or indeed they could have been very large issues that were outstanding, but the bonds have been tendered for by the issuing business, and it leaves a smaller size outstanding, which don't trade very frequently, but do offer enhanced yield to our investors. And that's something that we try to take advantage of, finding those bonds that are a little bit less liquid that can offer attractive yields to our investors right throughout the economic cycle. And it's the closed-ended nature of the fund that allows us to do this. In terms of the high level for the fund, this has been outstanding for over 10 years now. And of course, it's worth considering that for the majority of those early years, the yield available on UK government bonds, for example, were very low. So 5-year gilt offered yields of below 1%. So the fact that this fund has been able to achieve its minimum dividend return, which is about 500 basis points above that 1% that was being on offered by the 5-year gilt, I think shows how robust the structure has been, even through periods of very low yields. The fund currently has a mark-to-market yield of just under 9%, and it's relatively short-dated with an interest rate duration of just 2.5 years. Last year was very strong performance, and this year has continued in the same way with a very strong performance so far. I'll hand back to Ashley to talk about the dividend policy.
Thanks, Owen. Yes, I mean, you can see from this graph that the fund has always been able to exceed its 6p per share dividend policy every year throughout its life. You'll note that the last 2 years that we've had elevated levels of dividend, and that's been a particularly a strong factor over the last 2 years. As Owen mentioned, we've still got elevated purchase yields, so we are anticipating that our income levels are continuing above, are projected to be above that 6p per share every year. For at least the foreseeable future. Your existing shareholders will know that last year we actually paid out incremental amounts during the year to try and more evenly spread our dividends, and we paid out, in addition to the 0.5p per share every month, we paid out an additional 0.25p per share in respect of the March month end, and also the June month end as well. And definitely the directors, to the extent that they feel comfortable, that they will look to see whether they can more evenly spread any excess dividends that they're expecting in a similar sort of fashion going forward this year. But just to summarize, it has been the fund has continued to pay out strongly on its dividend policy, and we hope that that's going to feature again this year and for the foreseeable. And with that, I'll just hand back to Owen.
Thank you, Ashley. So to go into a little bit more detail on the kinds of assets that we try to invest in, and I think the higher yield environment that the fund is operating in at the moment certainly gives us a lot more flexibility. But this is a high conviction strategy. It's a high conviction approach that we take. So what we mean by that is that we try to focus on where what we think the best sectors are, the best industries to be invested in. And as you can see quite clearly, banks, insurance companies, and asset-backed securities feature very highly in what our favorite sectors are. We think European banks have performed very strongly over the last few years, and we expect that to continue. And the same is true for ABS and collateralized loan obligations, or CLOs. And I'll go into that in a little bit more detail in the future. What you will notice is that our high yield corporates is relatively low. We hold just 7% in European high yield corporates and 2% in US high yield corporates. And that's not because we think this is a dangerous area to be invested in. We're not expecting an increased default cycle. We're not necessarily worried about these sectors. We simply think there's better relative value available in other parts of the fixed income market. As you can see from the geographical breakdown, we also have a much greater allocation to the UK and to Europe than we have to the US. Again, it's been one of the themes in the fund for quite a long time. We see better value in Europe. And of course, the increased spending that we're likely to get from European governments over the coming years means that economic growth should be stronger in these regions. And again, that should benefit the assets that we're holding. In terms of looking forward, of course, it's always difficult to predict where the world's going to go and what kind of returns you can get. But one interesting, I think, study that we've done is looking at the US Broad Market Index, which goes back to 1985, and looking at how correlated starting yields are to annualized returns over a 5-year period. And as you can see, the correlation is very high. And certainly when yields are a little bit higher than they were a number of years ago, the correlation becomes even stronger. When you start with lower yields, there's always the chance that you have a negative total return. However, our yields at the moment in the fund is over 8%. And if you look at this study, it suggests that the returns that we're going to get is likely to be very closely aligned to the starting yield in the strategy. As I mentioned, we like corporate bonds. We don't necessarily think we're heading for an aggressive default cycle. However, spreads are tight. As you can see on this graph, the shaded areas show you the spreads available. The green shaded area at the bottom is European investment grade. The light gray shaded area is European high yield. And as you can see, spreads are down towards their lows over the last 10 or 20 years even. However, yields continue to look quite attractive. This is down to the fact that government bond yields remain relatively high. However, it's other areas that we find more attractive. So looking at European banks very quickly, the green line, which is the axis on the right-hand side, shows our common equity tier 1 ratio, which has been climbing very steadily, really, since the global financial crisis, and the average now is close to 16%. And on the left-hand axis, you can see non-performing loans, which are now down below 2%. So European banks, in terms of the strength of their balance sheets, have been getting better and better every year, and it's certainly an area that we think continues to look very attractive. And when you look at the yields available, you can see quite clearly that this is the case. This is looking at the CoCo bond index. Over half of this index would be investment grade rated, and you can see the yields available are very attractive in comparison to what you can find in high yield corporate bonds. So although spreads have continued to rally, as you can see in the shaded area, yields, as I mentioned earlier, remain attractive. And this is an area that I think we'll continue to find very attractive opportunities going forward. In terms of CLOs, or asset-backed securities, first of all, looking at the performance of these instruments over a long period of time, the light green bars here show the default that we've witnessed in high yield corporates. The dark shaded areas is the default that we've seen in high yield CLOs. As you can see, CLOs have performed much better from a credit quality point of view. Defaults have been much lower, and I think this shows the robustness of these structures. And they were tightened up quite considerably following the global financial crisis. And those new 2.0 CLOs that were issued since the global financial crisis, there hasn't been a single default in any European tranche since then. Nevertheless, although performance is much stronger than what you can find from a credit quality point of view than what you can find in corporate bonds, yields remain very attractive, and you continue to get a very attractive premium for investing in CLOs over and above what you can get from corporate bonds. Again, if you look at the dark green line at the top, this is what you can get from high yield CLOs, with yields just below 8% at the moment, while yields in the dark green line, which is from high yield corporate bonds, is quite a long way below that. And again, this is an area that I think we'll continue to find very attractive value. We have a large team at 24 that spend most of the time looking at asset-backed securities and CLOs, and it's certainly an area that I think a lot of us asset managers don't take full advantage of, and it's another way I think we can add a lot of value to this structure by targeting this asset class. So I think overall, at the moment, given where yields are, these are some of the best yields that we've had available in our market really since we've been running this strategy since 2014. And I think the outlook for the economy at the moment in Europe and the outlook for the assets that we're looking at remains very healthy. And we continue to think that we can find very attractive value for our investors going forward.
Ashley, Owen, thank you so much for your time today. Before we move on, if you'd like to be automatically invited to future updates from 24 Select Monthly Income Fund, then please respond to the poll now, and we'll ensure that you stay connected. Turning to our next company, I'm delighted to be joined by Laura Elkin, Portfolio Manager from AEW REIT. Laura, thanks ever so much for joining us this afternoon. Let's jump straight into things, and maybe you could tell us a little bit about AEW and what's driving the company forward right now.
Thanks, Mark, and hi, everyone. Thanks for joining us. I'm Laura Elkin, and I'm the Portfolio Manager for AEW UK REIT PLC. I've been part of the portfolio management team for the company since IPO some 10 years ago. AEW UK REIT PLC, or AEWU, is a London-listed REIT managed by AEW, one of the world's largest real estate managers. AEWU is an award-winning strategy that has achieved the highest level of NAV total return of all diversified UK REITs, and its portfolio has outperformed the MSCI UK Balanced Funds Index over all timeframes since completion of its initial ramp-up. Within our market-leading total return, we generate a high level of income, which we use to pay the highest dividend in pence of any diversified UK REIT. So this has been paid at 2 pence per share per quarter for 37 consecutive quarters. So how do we do this? We maximize income, and we start by buying properties with net initial yields generally in the region of 7 to 10%. We like to buy low rented assets, creating opportunities to grow income in the portfolio. Our average passing rent across our portfolio at the moment is below £7, so a very low level. We buy properties in strong commercial locations because we believe that's key to driving tenant and investor demand, and therefore our performance. Once purchased, we very actively manage our assets to grow income and lengthen leases. As well as focusing on income, we also work hard to protect investors' capital and to unlock capital upside. So in order to do this, we use a value investment style that is unconstrained by sector. And we believe that really the only way to carry out a value investment strategy over the medium to long term is in a way that is unconstrained by sector. And in practice, this means that we look across the whole UK commercial property universe to identify mispricing and to seek value. A key metric for us is to buy assets that are showing a low capital value on purchase as compared to their vacant value or alternative use value. This protects capital value, but also brings important optionality for change of use into our business plans, which can be both defensive and also create opportunities to create significant value. So hopefully that's been a clear introduction to our strategy, and the next slide sets out some key metrics for AEWU. These are as at the 31st of December, so apologies, slightly out of date now, but we will release our next set of numbers in April. I won't discuss all of these because some are mentioned on upcoming slides, but just to pick out a few, we have 32 properties in our portfolio, 112 tenants. Also want to touch on the gap between our net initial yield and our reversionary yield, which stands today at around 75 basis points. Now, this is reflecting the amount by which our independent valuers expect that we can grow our income. Our vacancy level at just under 9% is in the region where we would expect it to be, in the range of between 5 and 10%. We're very much not scared of vacancy in our portfolio, and in fact, we see this as an opportunity. We believe that if we've bought the right priced asset in the right location, when we actively manage it, we can maximize its value. So actually, vacancy and lease events we see as an opportunity in order to drive value. Our debt at 60 million is showing in the gross LTV of around 25% and runs at a fixed cost of just under 3%. The geographical and sector weightings shown on the right-hand side. Now, when we make asset decisions for purchase, we make these very much in a bottom-up way, but this can lead us to taking some interesting sector positions. An example of this is around 3 years ago when we held about 60% of the portfolio in industrials and far less in retail. But naturally, by recycling capital and selling assets where we had made profit and buying assets where we found value, this has seen us to buy counter-cyclically, and we have taken some profit off the table in industrials and bought into the much unloved retail sector in a very selective way. Now, these mispriced retail assets that we've bought in recent years are now providing a real boost to our income and performance, and particularly with our most recent asset sale in Coventry, on which I've got a slide to follow. Our focus on defensive purchase pricing has also provided a boost recently, where other investors have been losing value in the office sector. Our approach to buy at defensive pricing levels close to alternative use values has meant that we've seen much fewer losses, and actually also some significant opportunities where we've added a lot of value, as in the case of an asset in Oxford. Now, at the start of the presentation, I stated that AEWU had outperformed against its listed UK diversified peer group. And this is what you can see shown here by NAV total return. And for me, this chart really demonstrates the value of active asset management and crystallizing profit through well-timed sale. It's around the 4-year mark where we had been managing AEW and some of our asset business plans started to mature. And this is where you can see the lines in our performance starting to diverge. That same listed diversified peer group is shown here again, and you can see explicitly how AEWU's performance has consistently been stronger as measured by NAV total return on the right-hand side of the page. AEWU's share price performance has also been robust, trading much more closely to its NAV pricing than peers. I mentioned also that AEWU had outperformed the MSCI UK Balanced Funds Index, and this is the case quite significantly over every time frame since completion of our initial ramp-up. Our 5-year annualized outperformance has been close to 8% over this benchmark, proving that our strategy can deliver outperformance across a range of market cycles and also sometimes quite difficult market conditions. The next slide shows our dividend payment. Our dividend of 2 pence per share per quarter has been paid for 37 consecutive quarters. And these are shown annually here at 8 pence. The blip that you'll notice in year 3 is due to a change in our accounting period, but over the 12-month period, we did pay 8 pence. Now, as you might be getting slightly bored of hearing me say, we run an active strategy with assets being sold when values can be maximised to crystallise profit and then to recycle capital back into new return-driving opportunities. And what you are seeing on this slide is the impact that this active style has on our portfolio's income stream. Notably, around 2022, we sold our 2 largest assets in Oxford and Glasgow, and these were both sold to developers in order to maximise their value. And this saw us take both of those assets pretty close to vacancy, which created quite a significant knock on our income stream. And then obviously there was an inevitable reinvestment period, which also created cash drag. But I just want to reiterate that we are more than happy to do that in our strategy. Perhaps not every day to that extent, but because that drives the returns that we achieve. And because this active style is the driving force behind our total return outperformance, our board have been happy to support the payment of our stable market-leading dividend, even in these times of uncover. And this has been achieved using distributable reserves, so profit crystallized on prior sales. I just want to highlight that this total return approach to our dividend is a fundamentally different style to other REITs. And now it's important to say that this capital support for the dividend will not always be required. In fact, in the last 3 quarters, AEWU has been fully invested and has achieved greater than 100% dividend cover within each quarter. Unfortunately, these are not shown here on this chart because we're just approaching our year end. But for the financial year ending March 2025, we are on track to show a high level of dividend cover by income. Just returning to the topic of profitable sales, this slide shows every asset sale made by AEWU arranged historically. And you'll see that we have a strong record of crystallizing profits on sale over a range of market conditions. It's this taking of capital profit that is driving the distributable reserves mentioned on the previous slide. Now, at year-end March 24, the distributable reserves level stood at around 25 million. And given the profitable sales made within the company over the last 12 months, it's pretty reasonable to expect that come the next year end, that figure is going to be higher. Now, if I can draw your attention to the right-hand side of the chart, you'll notice that the bar there, Coventry, has been our most recent sale. And on the next slide, I'll talk through the business plan for that asset in more detail. So Central 6 Retail Park in Coventry was bought in 2021 for 16.4 million, reflecting a capital value per square foot of £110 and a net initial yield of 11%. The asset had 25% vacancy at the time that we bought it, so it was feeling rather unloved. Our team identified, though, that the location looked very strong, being both close to the city centre, the train station, and being very accessible from the road network. The recent relaxation of planning laws allowed us to bring in a wider range of tenants to the retail park, and this drove footfall. We achieved a long-term letting to Aldi and to Iceland trading as food warehouse, and to a national dental operator. And this has resulted in something akin to a traditional high street, where customers can make a number of stops and prolong their dwell time. The asset is now fully let with a net operating income some 50% higher than at purchase. We sold the asset in November for a price of around 26 million. Now, the sale of Coventry left us looking to reinvest and finding some significant opportunity in the current market. And as counter-cyclical buyers, we often find that in times of political uncertainty, we can find actually a lot of opportunity and particularly fruitful purchasing opportunity. And we saw this following the premiership of Liz Truss, when we had fortuitously sold our 2 largest assets in the lead-up. The subsequent period of opaque pricing strengthened our hand in negotiating with vendors, and we achieved some attractively priced purchases. So a similar effect is being seen at the moment, although not quite to the same extent. And we achieved 1 purchase last week with another, hopefully to follow very shortly. So last week we acquired this asset located on Bancroft and Portmill Lane in Hitchin, Hertfordshire. It's in a slightly smaller town than most in AEWU, but one with a very affluent catchment, which of course works for a high street retail asset. The lot size of 10 million reflects a capital value of £210 per square foot and net initial yield of 8.3%. All of the tenants within these retail units are known to trade very strongly, which is one of the important measures for us when buying retail. We also know that despite that retail unit, all of the retail units being fully let, we know of various tenants who are interested in coming into the location, which clearly drives quite an interesting supply-demand dynamic. The capital value here is well below the surrounding residential levels, so the asset provides not only a strong income stream, but a defensive capital position as well. So before I conclude, I just want to touch on the industrial sector, because that represents not only the largest holding for a sector holding for the portfolio at around 40%, but it's the sector in which we see perhaps the greatest propensity for income growth over the next few years. And the successes of the industrial sector have been clearly well publicised, but we actually see some great opportunities coming up, and both to grow income and also capital. Now, you can see from the pictures here that the industrial assets owned in our portfolio are not the new build prime logistics units. These second-tier low-rented assets, where occupiers often can't afford to move premises due to rents having come on so much in the sector. And we're finding that this creates a strong negotiating position with our tenants at expiry or lease review. I'll just pick out one of the examples. So in Runcorn, we bought this asset back in 2015 with rents in the region of around £5 per square foot. By about 2023, we had grown those rents to around £7 per square foot. But about 18 months ago, a tenant on the estate went into administration and was lost. Now, coming back to that theme that I mentioned at the start of the presentation, that vacancy can create opportunity for us. We took that unit back from the tenant who had failed, completed a refurbishment, and now we are letting that unit for a rent in the region of £9 per square foot. So showing how far the rents can grow, but also how opportunities can be created at times of vacancy. So I'd like to conclude with two main points. Firstly, that we are really proud of what the company has achieved. We've seen some great outperformance, but we still believe that the portfolio today represents a value proposition with low capital values and room for income growth, as demonstrated by the portfolio's independently assessed reversionary yield. Secondly, that our purchase in Hitchin last week and the next asset to follow, hopefully very shortly, are proof that our attractive pipeline is still very relevant at the current time. And to finish, I'd just urge anyone seeking greater information on the company to please visit our website or get in touch.
Laura, that's great. Thank you very much indeed, and some very useful insights there for investors. I guess one question, if I may, before we finish is, what should investors really expect from you over the next few years? What would you say to them?
Yeah, thanks. Well, over the next few years, I'd very much like to think that we would have continued our strong level of performance. Looking at our portfolio, and clearly I can't give out any specific details here, but we do see a lot of opportunity. And I've talked about how that's represented by the reversionary yield, but also specific assets where we're working on business plans at the moment for capital growth. Some of those are really exciting. I'd also like to think that over the coming few years, we can grow the company. And this is really just as a result of having looked at our pipeline very recently and reinvesting these proceeds from the sale of Coventry. We see a really attractive pipeline at the moment, and sometimes it can feel a bit frustrating that we aren't able to get our hands on all of that. We'd certainly like to have more purchasing power than we have at the moment. So growth within the company would be great, I think, for us as well.
Laura, thank you very much indeed for joining us today. Before we wrap up, if you would like to receive automatic invites for future updates from AWE, then please respond to the poll now and we'll ensure that you stay connected. So that concludes today's Spotlight event. A huge thanks to all our presenters for sharing their investment case and to all of you for joining us today. Now, we want to hear from you, and we'll shortly redirect you to provide your feedback. Your feedback is incredibly important to us. It really helps us shape the conversation between companies and investors moving forward. So thanks again. We look forward to seeing you at our next Spotlight event, and please do give us your feedback.